Now that we have defined risk, let's look at how to measure risk, and we're going to do that by looking at risk in the market.
In this spreadsheet, I've gathered information about monthly returns on many securities, individual stocks, the S&P 500 index, the Russell 2000 index, and 10-year treasuries. I've downloaded all these. This spreadsheet is quite large. It's got a lot of numbers in them. It's available in the folder on Blackboard under Risk and Return chapter, and I strongly recommend that you have this open so that you can see where all this is going from, to just in case you can't really see the numbers all that clearly on the video. So for the 1988 to 2016 period, I've gathered and calculated the annual returns on the S&P 500. That's 500 largest U.S. firms. It captures about 85% of the stock market's value. The Russell 2000, I've gathered annual returns and monthly returns on that as well. The Russell 2000 captures returns on smaller company stocks, and the 10-year Treasury bond as a measure of a risk-free rate of return. And if we look at it in a chart, we can see here the blue is the S&P 500 returns each year from 1988 to 2016. The orange is the Russell 2000 returns for the same period, and the gray there, that's the 10-year Treasury bonds. And not surprisingly, the 10-year Treasury bond is our proxy for risk-free rate. You can see that there's not a whole lot of variability there. The returns are relatively small. And it appears, it's quite clear if you look at the orange values there, that the Russell 2000 has more variability. In other words, it tends to have lower lows and higher highs. Not all the time, but most of the time. So the Russell 2000 as a measure of small company stocks, we can see small company stocks are riskier than large company stocks. The small company stocks in the Russell 2000, large company stocks in the S&P 500. For the Russell 2000, and in the up years, the Russell 2000 tends to be higher than the S&P 500. That's not always the case, right? We can see a period here in the mid-90s where big company stocks actually had higher returns than small company stocks, but most of the time, the small company stocks, when the market's up, they tend to have more positive returns, and when the market's down, they tend to have more negative returns. Not always, but most of the time. But we would like to quantify what we see visually in the chart. So looking again, annual data for the S&P 500, Russell 2000, the Treasury bond, we can calculate some statistics on this. So first of all, we can calculate the mean annual return. So what is the annual return on the S&P 500? Well, that's just going to be the simple average of those annual returns from 1988 to 2016. So if I click on the cell there, you can see the formula. It's just the average of the returns. And the average return on the Russell 2000 is a little bit higher, 9.28%, and the average return on that T-bill 10-year T-bond is 4.87%. Now if we just look at the 2007 to 2016, so the last 10 years, we see that the S&P 500 6.63%, Russell 2000 7.94%, and the 10-year Treasury bond 2.6%. So, as a general rule, the riskier the investment, the higher return, or the less risky the investment, the lower return. So we see the investment with the lowest risk, the 10-year Treasury bond, sure enough, its return are lower than either the S&P 500 or the Russell 2000. And the Russell 2000 being small company stocks, it has the highest risk, but we see it also has averaged over some period of time, had the highest return as well. So we see that risk-return trade-off. We can quantify that risk. Let's just look at the range from the minimum values to the maximum value. So for the S&P 500, over this 1988 to 2000 time period, the smallest return on the S&P 500 was a negative 38%, and the smallest return on the Russell 2000 was a negative 35%, and for the 10-year Treasury, it is 1.68%. And if we look at the upside, if we look at the upside over that same period of time, the maximum annual returns for the S&P 500 it's 46%, for the Russell 2000 it's 61%, and for the 10-year T-bonds, it's 9%. So if we look at this range, here we look at the range of annual returns from 1980 to 2000. The range on the S&P 500, this is the difference between the minimum annual return and the maximum annual return from 1988 to 2016. We saw that range was about 84%. For the Russell 2000, that range was about 96%. And for the Treasury, the 10-year Treasury is about 7%. So the range was much larger for the stocks than it is for the Treasuries because they're riskier. And the range of annual returns for the Russell 2000 is greater. So it has greater variability. And we see that same pattern kind of playing through in the 2007 to 2016, the last 10 years, where we saw that the S&P 500 ranged from a negative 37% to a positive 46%. By the way, the last 10 years captured the minimum and maximum value of the S&P 500 over the last 30 years or so. And then if we look at the Russell 2000, we see that variability is greater there, as well as with the T-bill, we see a bit smaller. So if we look at the range of annual returns for 2007 to 2016, we still see the same general pattern. Not much range in the 10-year T-bill, quite a bit of range in the riskier stocks. So we would say, just based on the range and the variability, that the Russell 2000 has the greatest risk. Small company stocks have the greatest risk. Big company stocks has the next level of risk, and this 10-year Treasury bond doesn't have very much risk, relatively speaking. We can get a better measure of risk by calculating the standard deviation. So the standard deviation is a better way of capturing risk than simply looking at the range of annual returns. So we look at standard deviation, as the name implies, we're standardizing this variability, this range in annual returns, and we're standardizing it by looking at the number of years. So mathematically, the standard deviation is equal to the square root. As here in the numerator, we're just adding up for each year the difference between that year's return and the average annual return, and we square that, and we divide that by n minus 1, the number of years minus 1. But minus 1, we get that. You may recall from your statistics class, we have something called the loss of a degree of freedom, because we only have we don't have the population average return, the X bar. We don't have that for the population. We only have that for the sample, so we're having to estimate the returns on either the S&P 500, the T-bill, or the Russell 2000. We're having to estimate that we really don't know it. So statisticians, they do this n minus 1 to correct for that loss of freedom, that loss of precision that we have, because we only have the sample mean and not the population mean. So let's work through how this would actually work using our S&P 500. I'm just going to do 3 years here to keep it kind of simple. So if we look in 2014, again, just kind of pulling this 2014, 15, and 16 for the S&P 500 annual returns, you see that in each year that's 7.29% to 17.94%. So to calculate the X minus the X bar is simply the average return over those 3 years is 5.81%. So if we take 7.29%, subtract 5.81%, and then square that, as you can see what we've done here in the equation right up here, we get 0.2%. For 2015, that same math works out to be 1.85%, and then 2016, we have 1.47%. Again, X, the return, 17.94% minus 5.81%, and then squaring that is where we come up with that 1.47%. Again, I really encourage you to open up this spreadsheet, play around with the numbers a little bit, see these cells, see how these calculations are being performed. And then we have our n minus 1 in the formula. Well, we have 1, 2, 3 years, so n minus 1 would be 2. So when we calculate the standard deviation, we're adding these numbers up, dividing them by 2, and then taking the square root, as you can see here from the formula right here. We come up with a standard deviation of 12.94%. And if we use the Excel stdev.s function to calculate standard deviation is quite a bit less work using the Excel function to calculate the standard deviation. And then using the Excel standard deviation formula to calculate the standard deviation over this entire period from 1988 to 2016, we saw that the standard deviation of the S&P 500 is 16.47%. Now, over this entire period of 1988 to 2016, the mean or average return, the X bar from before in the formula, is 8.91%. And our standard deviation is 16.47%. Now, if we assume that the returns to stocks are normally distributed, and I'm not saying that they are, we're just making that assumption, but it turns out that it's not a completely unreasonable assumption. So for illustration, we look at the normal distribution. You may recall the normal distribution, it's that bell-shaped curve. And if we look at a range from -1 standard deviation to 0.1 standard deviation around the expected return, we're going to capture about 65% or 68%. What does this mean? 68% of the time the returns on the stock are going to be within minus or plus 1 standard deviation from the mean. And if we go out 2 standard deviations, that's 95% of the observations. If we go out 3 standard deviations, that's 99% of the observations. So for the S&P 500, over 1988 to 2016, we calculated the mean and standard deviation. So in that range of -1 to +1 standard deviations, we would say that 68% of the time, we would expect the returns on the S&P 500 to be between a -7.56% and 25.38%. And if we go out ±2 standard deviations, so we're just taking the mean, 8.91, minus 2 times 16.47, that's where we come up with a -24.03, to plus 2 standard deviations of 41.86%. Again, I urge you to look at these cell formulas. So that range of -2 standard deviations, +2 standard deviations around the mean of 8.91%, 95% of the time we expect it to be between -24 to a positive 42%. And then we expect ±3 standard deviations. That's looking over here at our chart here, that's 99% of the time. So 99% of the time we would expect the returns on the S&P 500 to be between a -40% and a positive 58.33%, ±3 standard deviations. We saw that the Russell 2000 index of small company stocks had a higher return, but it also had higher risk than the S&P 500 or the Treasury bonds. The coefficient of variation is a way of capturing that risk-return trade-off for individual assets. The coefficient of variation, CV, is a measure of relative dispersion, and we use it to compare the risk and returns of different assets. The definition of coefficient of variation is risk divided by return. In other words, standard deviation divided by average return. So this gives us a measure of how much risk do we have to take per unit of return. And because we assume that investors and business managers are risk adverse, they would like to have lower risk, a lower standard deviation for each unit of expected or average return. So the CV, if we're comparing the CV of 2 different assets, we'd want to choose the asset that had the lowest coefficient of variation, the lowest CV. It's kind of like a golf score. Lower is better because we would like to have lower risk for each unit of return.